Welcome to The Explainer. Today, we're cracking open New Zealand's goods and services tax for any business that operates overseas. In the next few minutes, we're going to give you a clear roadmap to figure out exactly what your obligations are.
So let's just start with one simple question. Does your business have anything to do with New Zealand? I mean, maybe you're selling products there, providing digital services, or even just sending staff over for training. If the answer is yes, then you really need to get your head around GST. And this explainer is here to help you do just that.
First things first, what even is GST? Well, at its core, it's a 15% consumption tax that gets added to the price of most things sold in New Zealand. If you're familiar with VAT, or a value-added tax, it's basically the same idea. It's a really fundamental part of how their economy works.
So here's our game plan. We're going to walk through the 5 main situations you might find yourself in. Then we'll dive a little deeper into the specifics of selling goods versus services. We'll even cover a weird one, how you might be able to claim GST back even if you don't make any sales there. By the end, you'll know exactly where you fit in.
All right, let's get right to the heart of it. New Zealand's tax system sets out 5, and only 5, distinct pathways for overseas businesses. Think of it like a choose-your-own-adventure book. Your business activities are going to lead you down one of these paths.
And here they are. So are you supplying goods or services that are physically inside New Zealand? Or are you shipping low-value goods to New Zealand from another country? Maybe you're in the digital world, supplying remote services like software. Or perhaps you're using a marketplace for things like accommodation. And then there's the last one. Are you just spending money there and want to claim it back? Figuring out which of these buckets you fall into is absolutely the most critical first step.
Okay, so let's tackle the first big one, selling physical products. Now, this might seem pretty simple on the surface, but the rules change completely based on one single critical factor. Where are your goods at the exact moment a customer buys them?
And this is where it gets really interesting. It all comes down to where your stuff is when someone clicks that buy button. If your goods are already sitting in a warehouse in New Zealand, you're playing by one set of rules. But if you ship them from your home country after the sale is made, well, that's a totally different ballgame.
So, this first scenario is pretty straightforward. If you're using a Kiwi warehouse or some kind of third-party logistics company to store your products, you're basically treated just like a local New Zealand business for GST purposes. That's it. The location of the stock is the only thing that matters.
So let's bring this to life with an example from the source material. There's this company, Cozy Kangaroo. They're Australian, they sell board games. And to make things easier, they ship big batches of their games to a warehouse in New Zealand before any customers have even looked at them online.
And this just perfectly illustrates the point, right? Because those board games are already sitting in an Auckland depot, when a Kiwi customer makes a purchase, those rules for imported goods, they just don't apply. The tax office sees the sale, the supply, as happening inside New Zealand.
So, what if your goods aren't in New Zealand when they're sold? Well, that brings us to our second scenario, which is all about something they call low-value goods. And this category is only for physical products that you ship to a customer from outside New Zealand after they've already paid for it. And here's the first magic number you need to remember: 1,000 New Zealand dollars. That's the threshold per item. If a product costs more than that, it's handled differently at the border. But for items under $1,000, the responsibility to deal with GST can actually fall on you, the seller. And here is the other magic number. This one is huge. If your total sales of these low-value goods and any other services to New Zealand customers goes over 60,000 New Zealand dollars in any 12-month period, you have to register for GST. This is such a critical figure to track. If you're getting close to that number, you'd better have a plan in place to start collecting GST, because as soon as you cross it, you're on the hook.
Okay, we've talked a lot about physical goods, but what if you don't sell stuff you can touch? What if you sell services? Well, let's shift gears, because this section's for you. In today's economy, this is a massive area. And yeah, New Zealand has some very specific rules for it. So when they say remote services, they're talking about a huge range of things. Think about digital content like streaming movies, ebooks, or music. It could be software, games, or even professional services like accounting or web design, as long as it's delivered to a Kiwi customer from outside the country.
So, how do you know if you have to charge GST? Well, it all comes down to one question. Is your customer a New Zealand resident? And you can't just guess. The tax office expects you to collect at least 2 pieces of evidence that don't contradict each other to prove it. So you're looking for things like their billing address, their IP address, bank details, even the country code on their phone.
Now, there's also a pretty new rule you need to know about that targets online marketplaces.
Since April 2024, big platforms that connect people for services like ride-sharing, food delivery, or short-term rentals, they are now the ones responsible for collecting and paying the GST. This basically shifts the burden from the individual driver or host onto the big platform itself.
Okay, but what if you're not selling anything in New Zealand, but you're spending money there on business trips or something? Well, believe it or not, there's a pathway for that too. It actually lets you get a refund on the GST you paid. The ZNA Airways example from the source material explains this perfectly. So this airline, they don't even fly to New Zealand. 0 sales. But they sent a couple of pilots there for training. They spent money on course fees, hotels, all that stuff. Because those were legitimate business expenses, ZNA could register as a non-resident claimant and get all that GST back.
Now, you can't just do this willy-nilly, right? There are a few boxes you have to tick. First, you can't be making any sales in New Zealand that you should be charging GST on. Your business also needs to have a global turnover of more than 60,000 New Zealand dollars. And generally, your own country needs to have a similar tax system, like a VAT or GST.
So let's just pull all of this together. We've walked through the 5 key pathways: selling goods from inside NZ, importing low-value goods, providing remote services, dealing with marketplaces, and claiming expenses without making any sales. Now let's turn this into a final checklist for you and your business. And why does this matter? It's simple, really. Answering these basic questions will slot you directly into one of those 5 categories we just talked about. This is your decision tree. Just work through these questions one by one, and you'll know exactly what you need to do.
So now you have the tools. By figuring out if your products are in the country or imported, if your services are remote or on a platform, and whether you're even selling at all, you've basically got the map you need to navigate New Zealand's GST rules and find your correct path.